My next guest is a private equity investor who shares a story of 4 business adventures, 3 failures and 1 success. Now, with the success, a little spoiler alert, he sold the company for low 7 figures. He kind of walks through what the business model was and how he got there, but he also talks about what he did with the money and maybe some not so smart choices, which is kind of fun in itself. But then we lead up to what I would say is the most important part of the episode, where he talks about 5 hot business ideas for 2024, and he gives a reason why behind each. So if you're an entrepreneur looking to start a business, this episode is packed with some really good ideas. All right, let's dive in. Please welcome LaSean Smith. LaSean, welcome to the show.
Hey, Sean, how are you doing? Great to be here.
Yeah, doing well. How about you?
I'm well. I'm here in kind of mid-sunny Seattle. This is the time of year where folks, imagine Seattle to be very gloomy, and it actually is. But this is when I get a lot of work done. So I love this time of year.
Heads down. I hear you. When you got bad weather, like we just flipped from like 60s to 30s overnight, it seemed like. So here we go. Winter is here.
Yeah.
But anyway, why don't we dive in here? Tell us about your background.
Yeah. So I'll start at the top and then go back. I run a investment firm called Kager Investments. It stands for Compound Annual Growth Rate. So for the finance nerds out there, they'll understand that term. And it's really just a culmination of what I like to call, me tasting the buffet. So I've had a windy road in my profession. Started as a software developer, moved into user experience design. After business school, I worked as a product manager. And those are different roles within the software development process on how you kind of bring together a piece of software to life. And what it taught me was a lot about, number one, evaluating opportunities, because when you are building something new, is it new because of the technology, a regulatory change? Is there actually some customer behavior that shifted? And we try not to, build things because the technology is shiny and new, but actually because there's some demand there. The other piece is when you're building, the Peter Thiel book, 0 to 1, when you're building that version 0 to version 1, there's so many other broken things and systems and support structures that are not in place, that if you're a systems-based thinker, you'll quickly start to build a toolkit. And so through all of those experiences, at a certain time, I would leave corporate America, go off and start a business. I did that 4 times. 2 businesses failed horribly. One was an acqui-hire. That's a term for when you basically sell the company for break even to keep the team employed, and the 4th actually had a decent exit. And part of the learning there is just you got to keep trying, you got to keep showing up. But what I do today is try to take all of the pieces that I've learned through that and try to find interesting companies to either acquire or to incubate. And kind of my thesis is around audience and automation. So I look for businesses that can benefit from organic or content marketing paired with some process automation. So, there's ways to get rid of the paper, ways to reduce the human inefficiency. And we can get into more detail on kind of what some of those things mean. But there's an unlimited number of opportunities out there for folks looking at some of the small neck of the woods where I live. And I always like to kind of get out there, beat the drum, and let folks know my path, my option may not be the best for you, but I want to make sure you know that it is an option.
Sure. Awesome. Well, we'll dive into your private equity model here in a second. I want to back up and I want to learn about that. So 4 companies, and it sounds like 2 were failures, 2 were a success. Yeah. Okay.
Well, I don't know if the acqui-hire is a success, but at least it was, it wasn't like we burned all the cash.
Gotcha.
I've also done a 5th. I wasn't the founder, but I was an early stage executive and CTO at a venture-backed startup. Also learned a ton there. But a lot of these things are just that, right? Expensive tuition. And
yes.
It's like, all of these things create optionality. And just like any, option as an instrument, it's not worth anything if you don't exercise it at some point in the future. So you got to keep showing up to the plate and kind of retrying. So I think part of my success has just been that edict, double your failure rate, double your success rate.
Yes, indeed. Okay. So let's go back to that 4th company that was a success. Let's dive in a little bit. What kind of business model was it?
Yeah, so let's kind of hit the four quickly. The first
Good.
was it was an agency, and when it got really hard, I was like, oh crap, I'm spending so much time one to one on the sales process, the delivery piece, and support. And I was like, crap, this is not a business I believe
Yeah.
I can sustain, right? And so I effectively just kind of gave up on that business. The second business was it was a software company, and I was you know sold that I could do consumer better than anyone else. And so we attempted to build a music service, and we did really great on the biz dev. So we got some well-known musicians and recording artists, and I kind of tapped into some relations I had through friends and family. And, we solved that part. And the tech actually was not bad as well. But we had grossly underestimated our customer acquisition costs, our CAC. And so the cost to get people on this platform was just impractical. And so that flamed out. The third was this was the Acquihire deal. We built a piece of software to connect SMS to large stadium screens. And so if you think about this is a long time ago, it's still kind of a valuable thing. You have a captive audience at a football, baseball, basketball game, and you are trying to kind of get them more involved. A lot of these stadiums even today don't have great Wi-Fi, but they have enough coverage now where text messages works pretty well. And so we would work with a creative agency to create some type of visual participation. And it's like, if you look to the screen, such and such, and we'd give away signed, sneakers from one of the players at a big college game. One time we gave away a Harley Davidson motorcycle. And so folks were like, oh, I really want to participate. And they would see their participation in real time. The numbers will be moving based upon who's in the audience is responding over these text messages. But the real business model was the sponsor for those would get the whole CRM of the SMS database. And so they'd get this captive audience that they could retarget. And so the fundamentals of that business was quite sound. And we had some decent folks. We had an MLB team. We had a few college stadiums. We had I think it's crypto now. At the time, it was called the Staples Center in LA. So we had landed some decent size customers and spaces. But we realized, like, all right, this is going to be like a sales team, like a 3-person sales team in like every region. And so for folks out there who are doing like local marketing, one of the the hacks they say to start with is just go look at the football cities. Look at the cities that have a major football team, and directionally that's going to help you size out where there's probably enough kind of people density to kind of sort out these types of businesses. And we're like, all right, well, crap, we're going to need 30, 40 of these regional footprints. So that means we're going to staff up to 120 people. And we started to look at this and said, this isn't a technology company. This is a sales company. Mm-hmm. And we're like, crap. And so we ended up selling that to an agency that was they had a whole kind of swath of other services they were trying to sell to some of these sponsors, and they saw this as a great wedge. And so that was a good lesson on really understanding the dynamics of the business. And then the last company that I started was a mobile enterprise app company, and this was in 2011, so it's been a while. And what I learned, from those other missteps was really how to think about the end goal. Like, I went to this business like, all right, how do I sell this thing, or how do I get this to cash flow very quickly? I was like, well, like, one are the two options. There's no in between. We're not going to try to get on the VC train and keep this thing alive with hopes and dreams. And the unique insight, and I believe all businesses should try to find this, if anyone's aspiring to go start something, to have something that is unique. I believe it is Matt Ridley. He wrote the book, The Rational Optimist. And it's an interesting take. And the summary really is, for many folks out there, you want to have a contrarian view to the future that is both rational and optimistic. Right. And so when you combine all of those three, that's kind of where the value can be unlocked. You want to see the world differently than everyone else, but not through a pessimistic lens. You're trying to see the world through some optimistic lens, but you're not just some crazy dreamer. There's still a rational, pragmatic kind of approach to it. And so I went in this business, hopefully kind of keeping some of those ideals in place. And what I found, that unique insight, was at the time, the iPhone had been out for about 4 years, but no one had really figured out how to connect it to these big enterprise back end. So if someone gets a big paycheck for a big company, they might have that process through software like SAP or something like that. And we figured out how to take these big, heavy enterprise software systems and tie them to a mobile phone. And then we built a few little toolkits. And so sales teams love this because we were able to, sometimes in days, definitely in weeks, build these mobile apps where the sales team could have real-time access to their inventory. And really what set us up for success is we landed some really large companies, a couple of finance, what would now be fintech companies, a massive, one of the largest semiconductor manufacturers. And they had used this for sales enablement to say, like, all right, you want to buy X amount of these chips. How many do we really have? Right. We had some rudimentary forecasting models built in. And so they could just whip out their phone and see this. And it was like a no-brainer. And so as this market started to mature, folks looked around and said, like, who's in this space? Who are we competing with? And we were definitely punching above our weight. And at a certain point, some companies looked around and said, wait, hold on. Why is this little 16-person company in Seattle, Washington, have an exclusive with, some of these, large names? And when the first deal starts showing up, I realized, like, if we didn't say yes to one of these, somebody's going to step on us. And so I knew we didn't have a ton of runway. So even though the business was in good shape, I saw structurally in the industry, we didn't have a real moat. And so so we sold the company. And so anyway, I've learned through that process. I'll give you one bonus. After that exit, I had some cash and I tried a bunch of different things. I've invested in multiple independent feature films. I've, done a couple spec homes. I've, all sorts of asset classes where I've tried to learn. But one of the ones I did was I started a salad shop here in town. And, here's LaSean, software guy. And I'm like, I got this figured out. I'm going to help people eat healthier. I'm going to build this cool spot. And I don't really count this as one of my businesses because I wasn't the operator. I was the capital and kind of the strategic vision. But I share this story because it's one of the ones I'm most proud of. We started this business and I'm like, I'm going to have amazing branding. I have a pretty good taste for that. Our branding, our in-store experience was amazing. Our signage, we had beautiful photos, menu design was really well done. Tech stack, I'm like, we're going to have the best loyalty program, all your I had done all the things. And what got me was how grossly I underestimated how hard it was to kind of forecast, things with high spoilage, right? Salad dressing goes bad, romaine lettuce goes bad. It's hard to get folks who don't have a kind of a stake in the business to always show up on time. And I had to shut it down. And so one of my, kind of proud artifacts is on my hard drive is a screenshot I took from the Yelp page, and it says the name of the business was Fine Salads. It says Fine Salads, and then at the bottom it says permanently closed. You've probably seen one of these where like the business no longer exists, and like it seems silly, but every once in a while I just go pop up and look at that and be like, yep, that's what happened. And so So those have been some of the journeys along the way. And, that one wasn't super painful. It actually, taught me a lot. And now as I look and do diligence on deals, a lot of what I learned there helps me quickly suss out if I believe a, cash flow or revenue stream for a business is durable.
Yes, a great experience. And thanks for doing the kind of rapid fire timeline of these different ventures. Because I'm the same way. If people want to go through, okay, what were your failures? Buckle up. Here we go. One by one.
Yeah.
Can I ask this mobile app enterprise company? Can you share what you sold it for?
Yeah. So the company was called One Plane. We sold it. There was an earnout. So the actual ticket price was $5 million, but we sold it for $3 million. But we had no investors. And so, for some folks, they say like, well, that's just a tiny little exit. I had left Microsoft to start that. And this is another interesting story, I think, for folks who are struggling to kind of figure out, should they go and do this? We had, as myself and two folks I had worked with in the past, I had the capital, I had the idea, but, these things never work without others who help you out. And I had about $250,000 in restricted stock units. So these are RSUs or stock grants that you'll many times get at these corporations that had not vested. And so when I was quitting, like I had so much stress, because in my brain I was like, I'm leaving $250,000 on the table, and it just seemed like all the money in the world. And when it was probably about month 4 or so, I had pinged my CPA, my bookkeeper, and I was like, "Is this cash flow right?" Because we had a couple of deals, and so I knew the size of the deals, but I didn't. Sometimes these big companies, they don't pay you on time, and so you can see the paper number, but the cash flow number is a different number. And I said, "Is this number right?" She said, "Yeah, that's right. They paid at the top of it was like a net 45, and they paid in like 7 days. And anyway, there was like 700 something $1,000 in the bank account." And my brain was like, I was over here stressing over this $250,000 that I was leaving on the table. And in hindsight, 4 months later, like it was just so silly how I was, had this scarcity mindset. And
Yes.
wasn't really leading into, like, there was all this potential, and I was keeping myself down, right, by not taking action.
Yeah.
And I'm not saying people should just go out and squander bird in the hand, but what I'm saying is, like, for me, I had like slowed myself down because I was afraid to take action. And once I actually took, that true bias for action and moved, with some intention, things changed. A few things on that deal is, while that was a relatively, again, for acquisition standards, relatively small deal, because there's no investors, the liquidity was great. Two things that I did wrong. Number one, I had I didn't have a tax strategy in place, right? And so I paid some crazy taxes on that deal.
You didn't go into real estate?
Well, you saying what did I do with the money?
My first strategy would have been like try to prevent Uncle Sam from getting a big cut. Let's go into some syndicates, some real estate, large property.
So one of the things is, first, I just didn't have a strategy at all.
Yeah.
And so I knew some of the asset classes I wanted to move into. But the second is where the deal landed. I should have pushed the deal out to the top of the calendar year, so I had more time to go restructure and potentially find another deal to offset those. And so maybe it would have been some type of accelerated depreciation with some other asset class. But I was just all over the place on not knowing how to structure. And I was like, all right, there's going to be like $2.5 million in my bank account in a few days, and like my brain was like, let's go. The other piece is, I didn't last on the earnout, so I wasn't allowed to compete in a certain space, and I had a certain term that I had to kind of sit out of the game. That was really the core structure of that deal, whereas I couldn't go rebuild this type of company for a certain time period. And I just was getting antsy. There was all sorts of things. I would have restructured that earnout very differently now. And in hindsight, everything worked out. I ended up being a boomerang, as they call them in corporate America. I went back to Microsoft, and I took all those lessons. And this is, I think, something else that can be helpful for folks. I came in with a fair amount of leverage because, that wasn't enough money from that exit to retire, but that was enough to give me some breathing room on what I wanted to do next. Yeah. And so I made all my demands for that. And I structured my employee contract to really be option and stock heavy. And I came in on that deal at I think $35, $38 on Microsoft stock price, and we know where that's at now. And that there's also a split in there, and so I made much more money just going back to corporate America than that exit. But it all is connected, right? Like, I don't have the courage to make the demands. I don't know the right way to structure that employment contract. I don't know any of these things. If I don't both have the courage and feel like I have enough leverage to say this is why I'm going to show up, and had a fantastic run there. And then through that space, I did do some of these other things and experiments that I talked about. And now I'm much more risk averse and structured on how I tackle things. But I got like all these samples at the cocktail party of these different ways that I could attempt to move. And I tried to find the right balance of, I need the intellectual stimulation, but I'm also not trying to just go chase the reckless deals.
Yeah. I want to jump into what you invest in a moment, but I just have to poke fun a little bit. Like you wanted to sample with ways to lose money, movie
Yeah.
industry,
Yes.
restaurants.
Oh my goodness. And the crazy part is, while my background and my family structure, we didn't have a ton of, kind of financial literacy wasn't something that I was,
Sure.
well guarded on. But over time, I started figuring out, and I got lucky with some great mentors and sponsors who helped me kind of avoid some like really, more dangerous mistakes. But for those examples, it wasn't that no one told me that those are super risky. It was my arrogance. I was like, I can do this better than anyone else, right? And that was the silly part, right? And so what I have come to realize is, my wins largely have been a point of two things. One, I just kept showing up. And so that's something that I think others can replicate. But two, I just showed up in industries that had these major tailwinds that were going to work regardless, right?
Mm.
And I was kind of misplacing my confidence, thinking like LaSean did some of that. And so where we play, I mean, that's one of the famous, Warren Buffett stories. I think is so critical. It's not just how smart are you, what's your system, how do you network, what customer problem are you solving? It's like, are you just getting in the right boat? And if you pick the wrong one, mathematically, it doesn't matter what you do, you may be at a disadvantage.
Right on. I have to ask here, would I recognize the two films you invested in? Are they bigger, like bigger box films?
Yeah, no, these are all independents, but we have
Okay.
done multiple deals. So the interesting thing about film finance, this is something that I've now learned. Again, once you get these reps,
Mm-hmm.
I love thinking about all these asset classes. I haven't done like collectibles or fine art or anything like that. But I now have learned how the Clearport works and how people use, art to do write downs, through, estate sales and transfers. But for films, two things for folks who are based in the US. And again, I'm not saying you should do this. This is very risky investments, but
Mm-hmm.
it might spark ideas for your industry or what you do. Number one is take a look at the tax code. And in the US, what happened years ago is there were other countries that start saying, come over to our country and we have a replica of these blocks in New York City, or we have a replica or what have you. Vancouver, BC, and Canada was one of the big ones to kind of kick this out. And so there was this Hollywood flight that was happening. So the IRS and the federal government passed this rule called Section 181. And what it allowed for was accelerated depreciation for both LPs and GPs, but primarily for LPs who are investing in film productions. And the way it would work was, and there's two crazy things. Like I still don't know how this was written into law, and it's been tried a couple of times. I think in the Obama years and the Trump years, there was are we going to take this thing down? And it keeps surviving. I don't know who's lobbying for 181. Maybe it's some Hollywood folks. But when you put $1 in, you are allowed to fully depreciate that dollar as long as one shot has been filmed for the project. So the project does not have to be completed. The project, it doesn't even have to come out. Like it's just
Really?
crazy, right? This is a really crazy rule, and you're allowed to depreciate every dollar you put in. And the way this works is it's a offset to your other passive income streams. So you don't get to take that dollar and get your dollar back. What you get, let's say if you're at a 37% tax rate, you will get a 37% discount. It's almost like donating to a nonprofit, right?
Yes.
Like there's a
Yes.
cap. Like the tax math is very similar, and you get that 37 cents in that tax year, right? So really, what you're putting in is 63 cents on the dollar in that production. So off the bat, you've now like softened the kind of economic structure of these deals, and so that's something I learned that's really really powerful. And then you can tax other local tax strategies. Louisiana, Georgia, they have additional things that you can kind of keep stacking these deals, and if you structure it properly, many times you can be at about 50 cents on the dollar for your production.
Wow.
Right. And so this is how most rational, kind of financially informed film producers or television shows are actually produced, right? Like no one's saying like, my cousin or my niece has this great idea, I'm just going to give them some money and let's hope it's a hit. No, there's a whole tax strategy that's really critical here. The second thing that's really interesting about this is the ability to do co-finance deals. And so what will happen is, you can do a spec film like you might build a spec house, right? And it's just as it sounds. It's highly speculative. You will probably go to zero. And so what happens is if you do a co-finance film, if you structure the deal properly, you say, hey, I am going to produce this project with these stars in it, and it's going to have, it's going to be done about this time. And there's all sorts of legal wiggle room on the buyer side. That's the distributor or the streamer. On like creatively, if you give us some stuff that's bad or it's just full of offensive content, like there's all these outs that don't give you a bulletproof guarantee. But that contract is effectively collateral that you can then go use to raise funding. And what you say is, we'll front the first half, you front the post-production and any of the marketing, right? And so that's a strategy where you have to go do the business development to have the relationships with the direct buyers, right? This isn't like going through a sales agent, but this is a really interesting way to go structure these deals. And you see this in real estate and other assets where you look at the capital stack, and it's like you have your GPs, your LPs, your mezz debt, your preferred debt, and so the debt stack or the capital stack looks very similar. Anyway, the punchline for this is. Did multiple of these. I've done 6 of these. 2 of them films have not come out because this was like 2.5 years ago, right? And so this is the other thing that is just like, goodness, these things take a long time.
They do.
But one was a deal with Netflix. It's a children's film called Fearless. And did really good on the window there. And another's called Venus is a Boy. Really proud of that one because we tried the film circuit, which is the film festival circuit, which can be really tricky. And that one was a film that landed in Tribeca and did really well in the circuit there. And that film was sold to Hulu. And so, you can make these types of deals work. The reason I would advise most people to stay away from this asset class is it's too permission based. And like I got so lucky so many times in my life where it's just like the timing was the reason it won. Like I sold my mobile app company, my enterprise company, and because of the timing, right? There was a little window, and the only credit I can give myself is like I'm paying attention to trends in the timing, but I can't guarantee that I was there at the right time. Right now, because we've moved out of ZERP and we're in a place where debt is so much more expensive, that film approach isn't going to work because the streamers and everyone they have much more leverage, right? And so they might give you a deal that is less attractive. They might want to stretch out the cash flow. Like there's all sorts of things that they can use to extract more value out of you because they have more austerity that they are following. And so the idea of like, there's all this cheap money, let's go make a movie and then sell it to, some big streamer. It's not something that you can replicate when, interest rates are high. So anyway, that's the story on that little side thing. But I've experimented with all these things and learned a ton of pieces. And what I love about, this randomness is, even though I don't believe most folks should follow a path like that, investing in films, there's so many things that apply to kind of just a traditional deal flow. And a lot of this, again, is like when you do enough of these deals, your brain starts to pattern match. And it doesn't matter if you go into prop tech or agriculture or, local B2B services, you're like, oh, a lot of this stuff carries from industry to industry, small company to large.
Right on. You see the formula that works. And at the same time, because I've been involved in a lot of different types of businesses and worked for some larger companies as well. So I know the edge cases on, hey, what's a scalable business? What's a business I do not want? Like I had an agency as well in the 2000s and learned, wow, this is not a scalable business model. As my revenues increase, so do my liabilities, my payroll.
Totally.
Very difficult. But yeah, this is a good segue into what kind of companies do you invest in today?
Yeah. So one of the things I found was through all of that randomness is I need to follow the type of businesses that don't just mathematically make sense, but are true to kind of how I get energized. I have a personal North Star that is 6 words, 3 sentences. Know thyself, make things, stay free. And like, this is just top of mind, when I'm saying yes to a meeting, when I'm, committing to do any business travel, to like anything that's using my minutes or my money. I am trying to say, like, am I violating my own personal constitution of those 3 sentences? And the first one is I have to know myself. And I don't want to be in a business that is against my values, obviously, but also where it's going to drain the energy from me. And, one of the things I really disliked about working in corporate America was I'd be on all these, meetings with peers and other things. They're like, why am I in this meeting? And it wasn't like the people weren't nice or what have you. It's just I didn't care about the problem or their customer, right? And at a certain point of seniority, you're not working on the same thing as the person next to you. They're in a total different business because you're all running your own business lines. And I just did not enjoy spending my time that way. The second is I like to be close to the making of things. There's that great Peter Drucker quote, the management consultant. The purpose of a business is to create and keep a customer. There's nothing else, right? And so basically, what I took out of that, and I've reminded myself, is there's, you make things and you sell things. Everything else, not to knock the lawyer or the HR professional or whatever, they're there to manage risk or people friction or all these other pieces because you're trying to aggregate labor at scale. But at the core, the two functions that matter and will, if you don't handle, you will go out of business, is somebody has to sell the thing and somebody has to make the thing. And I realized for me, while I really love marketing, a lot of parts about go to market. I started off as a software developer, and the power there is like you can have an idea in your brain, type on a keyboard, and the factory of the laptop spits a widget out, and like that is just really, really empowering to my brain. And so that's make things. And then the last is just stay free. One of the reasons I have not raised a ton of capital from LPs is the fiduciary duty that comes when you raise, or the hedge fund, a VC firm, a PE firm, those are 10-year relationships that you're committing to. Like, even if you don't kind of keep raising your assets under management and you start to, you're just like, all right, I've raised, maybe you've raised a couple $100 million over 2 or 3 funds. You still got to wind that thing down. You still may have board seats. You still there's all this work that happens. And you can't just say like, you know what? I'm excited about some new technology. I'm going to go chase this other thing. Like, here's my 2-week notice. And so I've learned enough from these other experiences, deals that I did, as an angel investor. That's a whole nother angle that I spent some time there to realize you have to take these relationships seriously. And for me, the freedom to move around and change my mind is very important. And so what I do now is every year, this is the window, kind of the season, in Q4, I spend time looking at different themes. Maybe we can hit some of these before we wrap up on like what I think are ideas where there's some opportunity. It doesn't mean I'm going to invest in every one, but it's really something for me to say like, okay, I'm going to give myself permission to go look at new things. And for the next year, I'm going to stay locked in focus on that thing. But I give myself permission to go look at something new every year. And that keeps me energized and refreshed, which is very different from folks who, they have a certain kind of capital stack that they have to allocate. And, the SEC is going to come a knocking if they don't, do right by their LPs. And like, that's a way you can make a lot of money. That's not a path for me.
Right on. This podcast episode is sponsored by Ticker. Ticker is a platform that helps you manage your own investments with confidence. Check this out. Let's search for Apple. You can see Apple is on sale. That's looking good. Score is 61 out of 100 and margin of safety is 75%. Higher the score, the safer the investment, and the higher the margin of safety, the higher potential returns you can make. In this case, you can see the share price is 175 as of the recording of this video. And the upside potential, the fair value, is $398. All right, let's look at a different stock. We'll go to GameStop. In this case, GameStop is overpriced. Scores 39 out of 100. That's not looking too good. And the margin of safety is 0%. Here's some other features within. You can create your own custom dashboard. I like to set up and take a look at the top gainers and losers in the last 24 hours. I also like to take a look at the top search stocks, but you can really customize the dashboard to whatever you want. We have stocks, ETFs, crypto. This is a big one. We have a watch list tool that allows you to add stocks to the watch list. And if anything changes, such as that score or margin of safety, you automatically get notified. I call it the set it and forget it feature. And then we have portfolio trackers and alerts. So if you're looking for strong stocks, want to avoid bad stocks, and learn how to invest, I invite you to join Ticker for free. Well, let's dive into that. What are some of the themes that are jumping out for 2024?
Yeah, let me hold up. I got the list open here. So I have 5 buckets here, and again, this is not a top-down analysis. We looked at every trend, and like there's a lot of anecdotes and personal pieces. I believe that your talent stack, what you're good at, what your interests and values are, and kind of where you have an unfair advantage, maybe it's your network or something else, is very important. And so my list of things, there's definitely a macro lens, but it's focused on some of the areas where I feel like I can add some value. But the first one is aging in style. And this is a very unpopular thing to talk about out loud. We know all of the boomers, and now even Gen Xers are starting to, they're hitting 50s, 60s, 70s. And we talk about this wealth transfer that's going to occur, where all these Gen Z and millennials are going to get all of this cash that these boomers have. The unique insight here is these boomers aren't trying to go out, not in style, right? They're like, I don't want to go to this raggedy nursing home. I don't want to not try this longevity practice. Like, they're spending more and more of their money, and they can't, they're not going to put this on TikTok and say, like, let me show you how I'm living my best life. One, that's not how they generally move. But two, the social norms will penalize someone who, in an economy that is unstable and there's a lot of folks who aren't doing well, you don't want to show yourself at some wellness retreat for $8,000 a week, where you're just like, getting my 65-year-old self tuned up, right? And so there's this whole shadow market of folks that are still both motivated and have the cash to spend. And the numbers are mind-boggling. I was at a Four Seasons over the summer, and their salespeople followed up and they said, "Hey, LaSean, we've noticed you've been staying at our hotels and blah, blah, blah. And we like to share some more about this opportunity for this new product that we're selling." I'm like, all right, this is a sales call. Maybe I can learn something from the sales call. I probably won't buy what they're selling, but they were pitching me on a Four Seasons airline trip. And I won't get into all the details of the thing, but it's basically like it's a branded Four Seasons, plane, and they take you to all these exotic places, to their hotels, and over the course of 14 days, you get this like amazing experience. The punchline is you got to buy at least 2 tickets, and each one is $130,000 to start. Right.
Okay.
So you're at $260 in on this thing just to start, and it's like $180 for like the package you would really want, right? So it's $360,000. This is crazy numbers, right? And I said no. I was like, yeah, I'm not interested in that. But I did a little digging after that sales call, like, who is actually buying this? And it is these older folks who they have these bucket list experiences, and they have a ton of cash, and the asymmetry in who has like these big buckets of cash is just really fascinating. The other part of that is longevity. So it's not that they want to take expensive vacations, or they want to buy, they're empty nesters and now they want to buy really nice houses. The side part on real estate is service-based residence for the seniors are exploding. They want to live in a Ritz-Carlton or Four Seasons branded residence. They don't want to mow the lawn. They don't want to do any of this stuff. And they're willing to pay a 2, 3. Here in Seattle, the Four Seasons, the HOA is $5,000 a month for these crazy numbers, right? And you're like, who has the money for this? These boomers. There's a percentage of them that have done very well in life, and they're going to give money to their kids and grandkids, but they are going to live in style, right? And but anyway, the longevity piece is a huge thing, and there's all sorts of new preventative ways to make sure you're keeping yourself in better condition. We see like the Brian Thompson or Brian Johnson folks who that's the guy from Braintree who spends, I think, $2 million a year kind of on his longevity. I have multiple friends who spend 10 grand a month on their personal longevity, and like it's just to me, it's crazy. And so anyway, I'm going to spend more time on that one, just kind of give you details. Like each of these buckets have a ton of kind of, layered insights.
Yes.
But this one is, there are folks who have high motivation, they're facing their mortality, and they have huge sums of cash. And because they're in the latter stages of their life, they've moved this money to, to bonds or to cash or some cash equivalent. So it's not even like it's locked up somewhere that's not liquid. Like, they could just write these checks. And so that's an interesting insight. And any, new business or even public companies that are trying to accommodate these folks who are aging in style, that to me is a really interesting space. I'll go through the others more quickly. GovTech, B2G, as we increasingly, are attacked by various kind of macro and social issues. We have more variability in values, and we have to figure out how everybody comes together. I think technology is going to be really key to that. As AI starts to put pressure on productivity and maybe job loss comes out of that, I think the government, I wish they wouldn't, but they're going to have to get involved on some place. Otherwise, we're going to have riots in the street and safety issues and what have you. And so it's not just like, oh, you should build SaaS for the government. I think there's a whole class of B2G investments, and it goes on the social safety side of things, the education, health side of things, maybe even housing, all the way to DoD and defense. We're seeing companies like Anduril and Palantir and others who are more on that side. And so when you look at this whole piece, it's just like, this is a bucket where it's been underserved. And if you follow a dual use technology model, so companies that they're building a product for the government, but it can also be repurposed for private sector, I think there's a lot of potential there. Prop tech, we know there's a shortage in construction labor, and I'm very bullish on folks who are trying to figure out how to retrain folks who have maybe moved out of that space, or train new folks who are like, I don't want to do physical labor. I just want to be famous on TikTok. You got to figure out how to get these folks involved. And I think you're going to have to add technology to allow them to work more efficiently, because you won't have enough people. And, immigration policy is likely going to also impact this. And so we're just not going to have enough humans to kind of get this thing sorted. So prop tech is a big one. I talked about solopreneurs. I'm very bullish in that there's a new class of tools that are going to allow people from 0 to 20 employees punch way above their weight. And I'm not just saying folks who, not to knock this, people who have, maybe, information or coaching businesses, but folks who actually can start delivering services in a meaningful way without being burnt out, as solopreneurs, because they can automate so much of the sales, delivery, and support, pillars. Then the last is virtual creators. This is something I learned from, my time in the entertainment industry, and I believe there's going to be a new class of there's going to be a celebrity disruption. There's going to be a new class of influencer. There's going to be a new range of Mickey Mouse. And there's a great chart on the web that I've gone back to a couple of times that looks at the top media franchises grossing. It includes merch, includes box office, home video, like all the revenue streams. And when you look at it, there's very few live action on the list. I think Star Wars is 5 or 6 or somewhere there. That Harry Potter is on there, but the number 1 is Pokemon. Number 2 is Hello Kitty. Like you think about this and you're like, oh my goodness. Another interesting one is Spider-Man is almost as big as Marvel. They're in the same slot. They're touching each other. And the reason Marvel has this crazy box office number, but Spider-Man has this massive merch number. And the reason I'm so bullish on this is if you talk to people about this topic at length, you will get a polarization very quickly. Not investors, but people who like, would you buy a lunchbox, or would you buy a sweatshirt, or would you buy a movie for your kid that has one of these fake, creators, kind of virtual IP characters on them? And the polarization is so extreme. I've learned when I hear that polarization, there's money to be made, because there's going to be folks who are like, I want the traditional way. I want to preserve the artist craft. And other folks are like, no, I want a hyper personalized experience where my kid can watch a movie that says their name in it. And when I see that, that polarization, I know there's some economic opportunity. So anyway, that's the big buckets, and hopefully that maybe can spark some ideas for folks.
I love it. Thanks for giving the rundown here. That might even be the title of the episode. We'll see. Yeah. But we got to wrap up here because we're running toward the top of the hour. I've got my next meeting. But real quick here, where can the audience reach you?
Yeah, well, two things. If folks actually have a business where they are looking to sell, I buy relatively small businesses. Typically, if the deal is under $10 million, but at least $500,000 in EBITDA, give me a shout. You can hit our group email at grow@cagr.com. And then if you just want to chop it up, maybe ask a question or just talk about any of these topics offline, you can find me on LinkedIn, and it's LaSean Smith, just my full name. Happy to reach out. DMs are open, and I'm pretty good at replying there.
Awesome. Well, thank you so much for your time, LaSean. This is great.
Great to hang out, Sean. Take care.
All right. We'll see you.